And joining us from Sydney, we have Fenton, Portfolio Manager for Tribeca Investment Partners, where he helps manage over $1 billion in assets, including the shares in Australia's big four banks. Sean, good Tuesday to you. Let's start with the lenders then, because we got earnings right now from Westpac, from Commonwealth Bank of Australia. How about the economic health right now, or the corporate health of the lenders in Australia?
Yeah, the corporate health's pretty good. So since the GFC, we've seen corporates really de-gear. Bad loans for the banks are coming down under control. What we are seeing is a bit more stress on the household. So there's certainly there's a lot more caution out there. Sentiment's weaker, and we are seeing a degree of stress amongst some households. So there is a bit of a tick up in arrears. So loans past due, and you're seeing provisions tick a little bit higher as well. And that's been a pretty common theme across all the bank reports. And you saw that in Westpac this morning as well.
Yeah, but we did see a boost up in its bottom line, up 11%. I think Commonwealth Bank saw over 20% growth. But as you mentioned, we are seeing a slowdown in the Australian economy, households being crimped. Do you think this is probably the peak, the top for earnings from these lenders?
I think the long-term earnings outlook for the banks is still solid, but it's pretty unexciting. So we are seeing de-gearing going on across the economy. So Australia does have a very high level of household debt to income, and that really has peaked out now. So from all sides, really, funding's constrained. The banks are very reliant on term funding from offshore, although they have been reducing this. So certainly the volatility you've seen in global markets just really constrains that further. But more importantly, demand's just not there from households at the moment. So confidence is weak, and that is it's constraining profit growth longer term.
Okay, so does that mean there is no value left in these lenders? You would sell out if you have some?
I think you can hang on to them. What they do offer is very attractive dividend yields, and as we go forward, because growth is slower, they start spinning out extra capital, so capital generation is going to be high, and once we get through all the Basel III adjustments, I think you can see them start to lift their dividend payout ratios. So they offer a degree of stable growth and high dividends. So I'd say they're unexciting, but certainly nothing to sell out of and avoid.
And ANZ, the best of the bunch, is that what you're saying?
Yeah, I think it's got a few more growth opportunities outside of Australia, which is pretty much maxed out on household borrowing. So moving into Asia, picking up some opportunities there, does really give it a leg of growth. It differentiates it slightly from the other banks. So we do have a bit of a preference for ANZ at the moment.
All right, well, let's talk about Qantas, the other big story that we're getting out of Australia this morning. Qantas coming out with their international 5-year restructuring plan. Anything you heard out of this report that has changed your outlook on the airline at all?
No, not in particular. It's pretty clear that the international Qantas mainline has been losing money, is under pressure. So the restructuring is not surprising, taking a bit of capacity out of the kangaroo route, working more tightly there with BA and using capacity more efficiently, cutting back on jobs in Australia and launching a premium airline across Asia to service the areas of growing demand. So probably see some hiring there, shift their cost base lower. So I think they're good strategic moves going forward. The company's very cheap at the moment. Frequent flyer programs, a good solid growth business that's performing well. So we do see some real value there. I think the good news out of that update is that there's no capital raising. I think there were some concerns that the balance sheet might be getting stretched. So they've deferred the purchase of their final A380s out. Really gives them a bit of breathing space on the balance sheet and a bit of time to restructure the airline.
Okay, well, we have Qantas shares trading up over 2.5%, so it seems like the market likes what they heard. Let's talk broadly before I let you go, Sean. At the end of this year, the ASX 200 index, broadly speaking, it will be higher on the year, you think?
I think so. I think what we've just been through is a big capitulation trade on the market. So clearly, globally, concerns rising that we're entering another financial crisis. But we don't really see the transmission mechanism there from sovereign debt concerns in Europe and the US in terms of disabling the banking system, as we saw post the Lehman Brothers collapse. So whilst growth might be a little bit more stagnant and certainly moves towards fiscal austerity around the world will constrain growth, we see Australia continuing to benefit from growth out of China. They've got the flexibility to maintain their current growth trajectory for the immediate future, and that's going to support commodity prices. So we're quite supportive of resources, commodities. We like the agricultural theme, and we are going through a significant mining capex boom in Australia, and that's going to support a lot of companies, a lot of earnings as well.
All right. So, Sean, thanks for sharing your time this morning. Sean Fenton of Tribeca Investment Partners joining us from Sydney.